Hey guys, did you know that all investment and retirement accounts are not created equal in the eyes of the IRS? In this video, you'll learn about the different types of taxation on those accounts, the choices that you have in terms of how much you want to pay when it comes to taxes, and also how the choice that you make could have a dramatic impact on your retirement future. Hi, my name is Matt Kennedy, and I'm the founder of Kennedy Wealth Design and the author of the best-selling book, Untapped Wealth. Now, I've worked with hundreds of entrepreneurs, business owners, and high-income professionals, teaching them how the typical financial plan is actually failing them. To learn more, be sure to subscribe to my channel and also click on the notification bell so that you're notified every time we post a new video. Now, let me set this video up a little bit here. I don't know if you're like me, but I hate standing in lines, especially at the airport. And I was really excited a few years ago to learn that I had a choice when it came to which line I would stand in at the airport. And all it took was a little bit of planning, a little bit of effort, and then I got my TSA pre-check and I got to bypass the really long lines and just sail through the really short TSA pre-check line. And I can't tell you how many times that has saved me from missing a flight, having that access to a different line than the masses. The same is true for taxes. What most people don't realize is that everyone is standing in a line to pay taxes. But what they also don't understand is that there are multiple lines that you can stand in to pay those taxes. And the line that you stand in is your choice. And the line that you choose to stand in determines how much tax you'll pay. So we could even say that how much tax you pay, both now and in retirement, is your choice. Let me show you what I mean. There's 4 types of tax lines that you could be standing in when it comes to your investments and retirement accounts. And the line that you stand in, as I said, has a dramatic impact on your retirement future. Let's look at those 4 lines that you could be standing in. The first is the tax deferred line. This is money that you don't pay taxes on now. In fact, you get a tax deduction to put money into this type of account. The money grows, tax deferred. You don't pay any taxes on it. And then you have to pay taxes when you pull the money out. That's the tax deferred line. The second line is the taxable line. This is the line where when you don't get any tax deduction to put money in this account. And as the money grows and earns interest inside the account, you pay taxes on the interest while it is growing. So every year you're going to pay taxes on this type of account. The third type of account is the tax-free account. This is an account that you put money in after tax, meaning you don't get a tax deduction to put the money in, but you put it in after tax, and the money grows tax deferred or tax-free while it's in the account, and then it grows, or it is tax-free when it comes out in the form of income. Now there's the fourth line that a lot of people don't think about, and it's what we call the tax exempt line. It's different than the tax-free line because the tax-free line in certain scenarios still has to be reported on your on your tax return. Tax exempt income is different than the tax-free income. The reason it's different is because in some scenarios, tax-free income still has to be reported in retirement on your tax return and could make other benefits taxable. So having and understanding tax exempt is very important. Now, while saving for retirement, we find that a lot of our clients, a lot of people have this type of scenario going. The bulk of their money is in this tax deferred account, their 401k, an IRA, a 403b, or a SEP IRA. Sometimes they have some money in taxable accounts, which would be a brokerage account, stocks, CDs, real estate income, and they have a little bit of income in tax-free accounts. And that's generally because most of the time our clients can't qualify for tax-free. And then most of them have 0 in tax-exempt money. The reason why a lot of people have most of their money in their 401k profit sharing plan or SEP IRA is because they believe and they're told that they get a tax deduction to put the money into the account. Let's test that. Here we have somebody who's age 35. They're contributing $40,000 a year. They're in a 30% tax bracket. And between age 35 and 65, they're going to contribute $1.2 million a year. Now, by contributing to this 401k profit sharing plan, they're told that they're saving $12,000 a year in taxes, which is interesting because they're writing a $40,000 check to their SEP IRA or their 401k profit sharing plan to keep from writing a $12,000 check to the government. That's interesting. But they're being told they're saving $12,000 in taxes. So their tax savings, I have it listed here as total taxes deferred. Their tax savings, what they think of as tax savings, is $360,000 over that 30-year period. And if the account grows at 6%, then their account balance at age 65 is $3.3 million. You can see right there. Now, that's the tax savings that they're told that they're getting while they are accumulating money for retirement. But let's look at what happens when they start spending that money in retirement. That $3.3 million account has never been taxed. And so if they're in the same tax bracket when they retire, there's $1,005,620 of taxes due. Now that's embedded in the account. If they pulled all of the $3.3 million out in 1 year, they would have to write a check for $1 million. That tax is going to have to be paid by someone, either the account owner or their beneficiaries, their family. So look at this. They get $1 million in taxes due versus that $360,000 of taxes saved. So what we like to say is that 401ks, SEP IRAs are not tax savings accounts. They postpone the tax. Another word for tax deferred is tax postponed. So they didn't give the government $360,000 while they were contributing, but they have to pay $1 million in taxes. Now, here's a question for you. Do you think taxes in the future will be lower, the same, or higher? Here is a chart graphing out the history of the highest tax brackets in the U.S. tax code. And just looking at this graph, would you say we are in a historically low tax environment or a historically high tax environment? I think we're in a low tax environment. In fact, taxes, you could say, are on sale right now. So what happens if taxes in the future are higher? So we've put money in and gotten a tax deduction today at a 30% rate. But then when we get to retirement, tax rates are higher because the government has to, fund Social Security and Medicare and Medicaid and pay our national debt. And so if our tax rate is higher and we're in a 40% tax bracket, what just happened to our account? What happened to our taxes? Now we have 1.3 million of taxes due versus the 360,000 in taxes saved. Let's just assume that when you go to retire, you are in a lower tax bracket and you're in a 20% bracket. You still have $670,000 in taxes embedded in the account due versus the $360,000 in taxes saved. So if we could design a great plan for you in retirement, it might look like this. While spending in retirement savings, gosh, if we could have no money coming out of tax deferred accounts, if we could have maybe a little coming out of taxable accounts, more coming out of tax-free accounts, and in our opinion, we want to make sure that you have a lot of money coming out of tax exempt accounts. One of the sources of tax exempt income in retirement is tax exempt cash flow from life insurance contracts. So notice here in my example, I've got $85,000 a year coming out of a life insurance policy in tax exempt income. Now let's compare that to taxable income. If you're in a 30% tax bracket, it would take $121,000 a year before taxes out of a taxable or a tax deferred account to then pay the 30% tax to equal the $85,000 of spendable income. So you could actually have $85,000 of income. You could say the equivalent value of that spendable income is $121,000 in a taxable environment. But then notice this. Let's talk about Social Security. If you and your spouse are both working and make a good income, the approximate maximum amount of Social Security income that you could receive is $90,000. Well, if your provisional income, now this is a formula that the IRS puts out and says that if your provisional income is above $44,000, now what's included in provisional income? Among other income, tax-free income from municipal bonds. That's put back into your provisional income. So if your provisional income is above $44,000, then 85% of your Social Security is taxed. So in this scenario here, $76,500 would be taxed of your Social Security. Now, to pay your Social Security tax and pay your income tax and have $85,000 left over after you paid all of your taxes in retirement, you would have to pull out $144,000 every year out of your tax-deferred 401k or SEP IRA in order to equal the tax-exempt $85,000. So you can actually have the same or more spendable income with tax-exempt money than with tax-free because of the way the Social Security benefits are taxed. To learn how you could get out of the tax line, click on the Show More tab below here, and then click on the link to take my masterclass and apply to become my client. And as always, please subscribe to our channel and click on the notification bell so that you'll be notified whenever we post new videos.